Global finance is shifting. Major US banks are pulling back from China, citing rising tensions, a slowing Chinese economy, and unpredictable regulations. Meanwhile, China is rumored to be selling off $1.7 trillion in US debt, a move that could shake the world economy. This isn't just a story for bankers, it affects everyone from students to everyday consumers. US firms face pressure at home to divest from China, while in China, nationalism and government control make business riskier. The economic slowdown, especially in China's real estate sector, has made the market less attractive for foreign investors. China's potential debt sell-off is seen as a counter-move, an escalation in a high-stakes economic chess match. These moves highlight the fragile, deeply intertwined relationship between the world's two largest economies. In this video, we'll break down how this interdependency formed, the risks both sides face, and what the future might hold. How did China become America's banker? It starts with trade. For decades, China exported goods to the US, earning huge amounts of dollars. With more dollars than it needed, China invested in US Treasury bonds, the safest asset in the world. By buying these bonds, China essentially lent money to the US government, helping keep the dollar strong and the yuan weak. This made Chinese exports cheaper, fueling China's growth and jobs. For the US, China's bond purchases kept interest rates low, making borrowing cheaper for the government, businesses, and home buyers. This cycle created a deep, mutually beneficial economic interdependence. China's investments helped finance the American lifestyle, while the US market powered China's factories. Both sides gained. China secured growth and stability. The US enjoyed low rates and affordable goods. But this tight relationship also means both economies are vulnerable to each other's moves. That's why today's standoff matters so much. Could China weaponize its US debt holdings? In theory, a massive sell-off could spike US interest rates and disrupt markets, but it's a double-edged sword. Dumping bonds would hurt China too, slashing the value of its own investments and strengthening the yuan. Bad news for Chinese exports. Most economists agree, a debt dump would damage both sides, making it an unlikely weapon. The US Federal Reserve could also step in to stabilize markets, and global demand for US debt would help absorb the shock. So, while the threat grabs headlines, it's more deterrent than real danger. The two economies are so connected that harming one would inevitably hurt the other. This shared vulnerability keeps both sides cautious, even as tensions rise. Despite its image of strength, China's financial system faces serious internal challenges. Local governments and state-owned firms are drowning in debt, much of it tied to a shaky real estate market. China's financial markets are less mature and more tightly controlled than those in the West, making foreign investors wary. Sudden crackdowns and lack of transparency add to the uncertainty. These weaknesses make it hard for China to turn the yuan into a true global currency. Geopolitical rivalry with the US has pushed China to reduce its reliance on the dollar, promote the yuan, and develop a digital currency. But building global trust and a resilient financial system takes decades. For now, China's dependence on the US market and the dollar remains a reality. Any aggressive move risks making China's own financial problems worse. The US-China economic relationship is at a crossroads, competitive, yet deeply interdependent. Trade disputes and tariffs show how tightly linked the two economies are, with real impacts on consumers worldwide. Even if China sold off US debt, global demand for dollars would likely cushion the blow. Both nations have leverage but also much to lose from escalation. China seeks financial independence. The US manages debt and competition. Their choices will shape not just their own futures, but the world's economic stability. Despite the rivalry, their destinies remain intertwined. The challenge ahead: manage competition without tipping into economic war.